Hello everyone. Today is actually a chilly day, and I hope you're keeping warm wherever you are. I just felt the need to say that in the beginning. I don't know why, but anyway, we are here. So as we cozy up, let's dive into our topic: alternative investments that aren't directly affected by the declining interest rates in Treasury bills and Treasury bonds, and of course, in money market funds. We are all talking about how interest rates are going down and how you earn too little in money market funds, and bills and bonds are not cutting it. So the next question is, do we stop investing or what? Where do we keep our money? Well, today I want us to go through 6 alternative investments that are not affected directly by the declining interest rate in government securities, so that you can be able to assess where else you can invest your money for better returns. We'll discuss the investment in details. We also go through the level of risk of these investments, and then we are going to look at who the fund is best suited for, and what percentage of your investment you should allocate to this fund, and last but not least, why you should consider investing in these funds. Okay, I have to say, this will be a very comprehensive video, and I will be introducing some new concepts, so I encourage you to get a pen and a notebook, so that you can write down some of the things that I'll be sharing here today. I will do my best to break down this concept into very simple language, and because we don't want interruptions in the middle of the video, I request that you subscribe as early as now if you have not, and I promise you'll find this video for their time. Okay, a disclaimer: these alternatives aren't for quick cash. Some requires patience and may take time before you realize your return, but they also hold greater potential than money market funds, much greater potential. Others have some level of risk, but remember, high risk, high potential returns, and a few might just change how you think about investment. So quickly grab that notebook and that pen, and let's do this. To our first investment, special funds. If you follow me, I have done some videos about special funds, and the best part of these funds are, just like any money market fund, they preserve your capital. So during my research, I have realized that we have some funds that sounds like special fund, but in fact, they are not special funds. Some actually have even the name special fund in them, but are not special funds per se. So today I'll be sharing very important tips to identify a special fund before you start investing in it. So let's start by defining what special funds are. So special funds are a type of collective investment scheme, so the same category with money market fund, and special funds are designed to cater for specific investment strategies. So these funds are managed by professional fund managers and are regulated by Capital Market Authority, just like money market fund. For special funds, they focus on non-traditional high-yield investment securities, and their aim is to maximize returns while protecting and growing the investor's capital. These funds usually use sophisticated trading models, including things like long and short strategies, meaning that they make money when the prices of currencies are going up or down, and then they also do derivatives, and they also do leverage trading. Leverage trading, for those who are new to this, is they can trade more than they have in their accounts. And these strategies are what make these funds special, and they do this to make sure you as an investor, you are receiving great returns for your investment. Something else that is very key with special funds, you will find that they invest both in local and global market. And when you invest in special funds, because of their level of diversification, your chances of losing your capital is very low. In other words, they preserve your capital, but they are often riskier than money market fund, and I will explain this in a few. So here we have established 3 things that you really need to keep in mind. Number 1 is they are collective investment schemes and regulated by Capital Market Authority. So when you're investing, you have to confirm that these are actually regulated by Capital Market Authority. This is very important, and I will go into more details about this while explaining the risk of investing in such a fund. But first, let's complete the 3 important things that you should note with these funds. Number 2 is they invest in non-traditional securities. These are funds you'll find that in addition to shares or stocks, they also invest in commodities, they invest in precious metals, they invest in ETFs, they invest in derivatives and other things like that, both locally and also globally. Number 3, they have sophisticated trading models, meaning they not only invest in assets, but they also do forex trading, which means, as we have mentioned earlier, that they trade when the markets are going up and when the markets are going down. And they also do leverage trading, which means they can trade more capital than they actually have in their accounts. All right, those are 3 things that you should keep in mind when identifying a special fund. What all this means is they are well diversified and their source of income are from different things, making it a moderate risk investment. And the reason why they are moderate risk investment is because the underlying assets they invest in are risky in nature and are volatile, meaning that sometimes it can affect your interest. And the other reason why these special funds are riskier than money market funds is, let me see, I think I should start with a money market fund so that you can be able to break it down for you to understand how this works. So if a fund manager were to go out of business and you are invested in a regulated, underline that, a regulated money market fund, the Capital Market Authority would step in and they would authorize the custodian to either transfer the money market fund or the funds to a new fund manager who would take over, or they would instruct the custodian to liquidate all the assets and return the money to the investors. And because money market funds invest in low risk, short term assets like government securities and bank deposit, it is usually possible to recover your full investment in case of a liquidation, but that would be the last resort, okay? On the other hand, things are a bit trickier when it comes to special funds in such a scenario. So if a regulated fund manager for a regulated special fund went out of business, the CMA would likely instruct the custodian to liquidate the asset or the investment, yes? However, since the underlying assets are often higher risk investments such as equities or maybe volatile assets, timing is the most crucial thing when it comes to selling such an asset. If the market conditions are not favorable at the time of liquidation, there's a risk of investors losing their capital. And unlike money market funds, transferring such a fund to a different fund manager isn't as straightforward given the complexity of the investment strategy and the level of expertise needed to make sure that the investors are getting good returns. Though it is possible, but the easier way out is through liquidation. So in such a scenario, even if the fund promises capital preservation, the chances of you losing your capital in case the fund manager went out of business is there. Okay, in case the fund manager went out of business. And these scenarios are rare, but it is possible, yes. And I have spoken to some special funds and they say in such a scenario, you can only lose up to 30% of your initial investment. But I think this would be determined by the market condition at the time of liquidation and the whole process that led to collapse of such a company. True. And the reason why I like talking about such scenario is because it keeps us on our toes to think about diversification of our investment, to think about risk mitigation, and basically to avoid having all our eggs in the same basket. That is the reason why I talk about such scenarios. So rare, but they can happen. And when we think about them, they make us distribute our investment in the right places, okay, so that we don't have all our investment in the same place. Now that you're informed, are you planning to invest in these special funds? An example of a special fund here in Kenya, we have Mansa X, we have Oak Special Fund, and also I've seen Avocap have a special fund, and I'm yet to review it, but I will do that soon. So make sure that you subscribe or stay tuned for that. Let me know in the comment section if you already have a special fund. Your experience might be encouraging someone to go for it. So share your experience in the comment section. I think that is well covered, right? So our investment number 2, we have REITs, and REITs is short for Real Estate Investment Trust, and this is another alternative investment that is not directly affected by the declining interest rates in government securities. So REITs, in very simple terms, are a way for you to invest in real estate without buying a property or managing a property yourself. Think of them as a pool where we pool fund, you and me as investors, we pool money together, and that money goes or is used to buy or manage or develop a real estate. And these real estates can be commercial buildings, they can be rentals, or we have also seen the booming market in the student accommodation. So you can invest in these real estate without directly buying the property yourself through REITs. In return, you get a share of income generated from these properties, and the income can be rent, or maybe it can be from the sale of the property. I personally don't own rentals or manage any property that involve other people, but they say managing one is not a joke and dealing with people is hard. Maybe you can let us know if you have experience with such, how true this statement is in the comment section. But REITs are here to solve that problem and to make you own property without going through the hassle of managing it. And the best part of it is managed by professionals, and you only wait to get the profits in your account. Are you sold? Let's look at the risk and how they work before you get in or you start investing in real estate investment trust. So generally, we have different types of REITs, but here in Kenya, we only have 2 main ones that are operating or are in operation. Number 1, we have income REITs, also called as I-REITs, and these REITs focus on income generating property like malls. They can also focus on office buildings, apartment, and of course the student accommodation. And with these REITs, you can earn returns through rental income, which is distributed as dividends to all the investors that have invested or have units in these REITs. Number 2, we have development REITs, D-REITs, and these are about developing properties. So the money that you contribute is used to or goes to building projects. It can be building rentals, it can be building apartments, it can be building malls or office buildings, and at the end of the development, the investment or the property is sold, and returns come when these investments are sold or leased. So basically, this is a long-term investment that you, after the project is done, that's when you get the returns. After the project is done and sold and or leased, that's when you get the returns, okay? Now, allow me to take a few minutes to discuss about or go deeper into the returns that you get from the REITs, and you're going to be discussing the I-REITs and also the D-REITs, okay? So the returns depend on the type and the performance of the underlying property, and you can earn in 2 ways. Number 1 is through the dividends, which you get when the properties you have invested in and profit. The law dictates that 80% of the profits made from these properties should be distributed to the investors. Number 2 is through capital gain. So every now and then, the REIT manager usually evaluates or re-evaluates the valuation of the REITs. And then after that, after the evaluation, the unit price can change, meaning that you can buy maybe a unit at 10 Kenya shillings, and when you're exiting the market, you sell it at a different price, maybe at 20 Bob Kenya shillings. So meaning what you invested will also increase in price. Okay, this is for I-REITs, and for D-REITs, they might offer higher returns than I-REITs, but you only realize the returns after the development or the project is complete. And in Kenya, the returns for real estate investment trust varies with the market condition, but they can go up to 15% per annum, which is pretty decent, yes? And an example of a dividend paid for Island Fahari I-REIT, which is also listed in the Nairobi Security Exchange, was they paid their investors 0.38 Kenya shillings per unit. That was in August 2024. I would also like to share with you this, and this will help see the returns of an I-REIT. This is the Econ student accommodation for 2024, and from this you can see they have 2024 and 2023 for comparison purposes. And in 2024, both 2024 and 2023, they gave 0.30 Kenyan shillings per unit. So if you have like 5,000 units in this I-REIT, you just multiply with 0.30 to see how much you're going to be earning, okay? Or you would have earned. Then we have annualized distribution yield, which is 2.7%. That was in 2024, meaning that it went down from 2023, which had 2.8%. Then annualized total returns. 2024 we had 5.3%, which was a drop from 6.5% in 2023. And then the net asset value, meaning that each unit goes for 22.21 Kenya shillings in 2024, and in 2023 it was going for 21.65, meaning that if you went in 2023, you made a capital gain if you exited the market in 2024, okay? The management fee also went down from 1% in 2023 to 0.5% in 2024. And in 2024, they acquired one property that was not there in 2023, okay? These are long-term investments. When you're going in, you want to stay there for a longer period of time to make sure that you have realized or maximized the returns that are possible in this kind of investment. We are looking at 5 to 6 years there, so that you can actually feel or realize the returns that are the potential returns in this kind of investments. So in Kenya, we have examples, and examples of REITs that you can invest in is Island Fahari I-REIT, and this focuses on income generating properties like malls and also office spaces. And then we also have Econ student accommodation I-REITs, and also they have D-REITs, and these they specialize in student housing. And I am very sure that you have heard or you have seen the Kwetu or the Kijani brand that and you can actually be part of that project if you want to. And I would like to highlight how safe these investments are. So REITs in Kenya are regulated by Capital Market Authority, which ensures that ensures transparency and also to protect the investors. However, like any other investment, they are not entirely risk-free. I-REITs are generally safer because they deal with income generating properties, while D-REITs carry more risk due to the uncertainties of property development. Okay, they might develop their property, yes, but finding a person to sell to or to lease to, then that is another story. So I-REITs are generally less or safer than the D-REIT. So in conclusion, REITs are a great way to get into real estate without the hassle of owning the properties. They offer a mix of steady income and also potential growth of your capital, depending on which rate that you choose. Does this sound like something that you could consider? Let me know in the comment section. Also, let me know if this is something that will interest you, so that we can go into more details in analyzing them and looking at them and how to invest in REITs. Okay, now let us go to our investment number 3, yes, that have better returns than money market fund. And unlike our investment number 1 and number 2, this investment that I will be discussing here is slightly affected by the declining rates in Treasury bills and bonds, but not as much as in money market funds. And here I'm talking about equity funds, and I know this is something that people are interested in, and I'm here to tell you what they are and the risk involved in equity funds. Okay, so equity funds, just like money market funds, they fall under the collective investment schemes, and the asset allocation is the only thing that is different from now the money market fund. So for equity funds, they primarily invest in shares, so they can have up to 80% of the total assets under management in the shares. Okay, and the fact that they invest in shares, this makes them a high risk investment, but the potential returns are also massive. And then a very good example of this is Kuza Momentum Fund. If you have been following me, you know Kuza Momentum Fund. This fund gave up to 45% growth in 2024. And the fact that they invest in shares, this makes them a high risk investment, but also the potential rewards are also massive. Okay, and a good example of this is Kuza Momentum Fund, and we have discussed about this previously, twice actually, 2 videos on this, on Kuza Momentum Fund. At its basic, or at a glance, you would think, or at a glance you would think that this is a special fund, but the way it operates and the asset allocation, this is actually an equity fund. Okay, and for these two funds, if you notice, they gave the returns, massive returns in 2024. In 2024 they gave Kuza Momentum Fund gave 45 point something percent, and the Zimele Balance Fund gave 41%. And this is massive returns compared to other investments. And I have seen people saying that this is unrealistic returns, but that those are the potential of investing in an equity fund. But again, it's high risk investments, and my advice is you start small with this kind of investment. Put money that you don't need in the near future, because if you sell at the wrong time, you make major losses. These investments are recommended to be held between 3 to 5 years, so that you can realize their potential, or you can maximize your return. So make sure that when you're going in with money that you don't want to use in the near future, so that you can stay there long enough to make profits. So they have massive returns, but they are also high risk investment, but they are investments worth considering, because you stand to gain a lot if you invest in this type of funds. So if you have a money market fund in place for an emergency fund, start thinking about going to such investment. And again, remember to put not more than 20% of your investment portfolio in such an investment. But this fund, they're very good, and try out for their potential returns. All right, and an example of equity fund in Kenya that we have not mentioned, that is clearly an equity fund and it's labeled an equity fund, we have CIC Equity Fund. And most of the fund managers who have money market fund, they also have equity fund. So you can check whether your fund manager have an equity fund, and you can consider investing in them if it's something that would interest you. So remember, this video is for information purposes, to make sure that you are in the know about this kind of investment, but this is not financial advice. Make sure that you do your due diligence to understand the risk, and also to understand if it's something that would interest you. And our number 4 investment, we are going to be discussing balance fund. And I know, unlike the funds that we have discussed previously, balance fund is also slightly affected by the declining rates, but it's not as much as money market fund. So here we are looking at alternative investments that you can maybe take advantage of instead of investing all your money in a money market fund. Okay, so a balance fund, just like money market fund, fixed income funds, equity funds, and special fund, they fall under the collective investment scheme, and they are regulated by Capital Market Authority. And if you decide to invest in one of them, make sure that you check if they are actually regulated by Capital Market Authority. So for a balance fund, this is like a mix of a money market fund and an equity fund, because in addition to them investing in Treasury Bills and bonds, they also invest a percentage of the investors' money in equities, or basically in shares. So these are less riskier than equity funds and more riskier than money market funds, but also the returns are also higher than money market funds, but lower than equity funds. Yes. Now, in balance fund, you earn in 2 ways. Number 1 is through income generated by the investment, or the percentage that is invested in government securities. Number 2, you also earn from capital gains, and this is basically from the amount of money, investors' money, that is invested in stock or in shares. So if you have higher risk appetite, but not so high as to go to equity funds, then you can start with balance fund, because it gives you a balance between high risk and also low risk. It's in between. So this is a fund that you can start with if you're interested, or if you want to explore other investments that are more riskier before you go to riskier investment, or investments that have more risk. And again, most of fund managers that do money market funds and fixed income funds, they also have balance funds. Some of them, you can check them out and find out whether the fund manager that you have invested in, you find out whether they have a balance fund, and check, or do your due diligence to find out if it's something that would interest you. Our number 5 investment that is not directly affected by the declining interest rate in Treasury bills and bonds, we have one that is very close to my heart called cryptocurrencies. And I know crypto doesn't have a very good name or reputation out there, but the potential returns, they are massive. And this can be illustrated by how a coin like Bitcoin moved from 40 bob in 2020 to now more than 10 million Kenya shillings. And the same goes to the second largest cryptocurrency, which is Ethereum. And I remember in 2020, December, one ETH was going for 10,000 Kenya shillings. And today, the price is more than 200,000 Kenya shillings. And I know you'll say that it is risky to invest in cryptocurrency, which is very true. But if you want to make money in cryptocurrency, what you want to do is to buy when the markets are down. So, when the prices are going down, when the market is crashing, that's when you get into the market. If you go in when the prices are high, you're going to make losses. So make sure that you buy when the prices are crashing so that in the next 45 years, you're going to be in profit. So when you invest, make sure that you invest something that you're willing to wait for 4 to 5 years, because when in cryptocurrency, it goes with cycles of 4 years. And if you do this, you will be making profit in cryptocurrencies. So don't go to invest in cryptocurrency to withdraw next year or to withdraw the next 2 years. Go in cryptocurrency thinking about long-term investment, 4 to 5 years investment. And when the market starts going up, remember to be taking profit so that the next crash doesn't find you in the market. So what you want to do is to invest when the markets are going down and then start taking profit when the markets start going up. So one thing that I would advise, never sell a crypto below the price that you bought. If you bought at a certain price, make sure that when it goes higher than that, you are able to sell that cryptocurrency. And this process is made very easy. With some of the markets that we currently have, it's very simple to sell and also to buy cryptocurrency with actually using M-Pesa or your bank account. Okay, and when you're choosing a cryptocurrency, and I'm going to do a video on how to choose a good cryptocurrency, you want to look for cryptocurrency that support a certain project, meaning that the demand for that coin will continue going up, and even if you wait long enough, that coin will not crash because it has a value in the market. Okay, our number 6 investment is shares. Shares are also very volatile, and as we have talked about crypto, you want to stay long enough to realize the growth in shares. Plan for 3 to 4 years, and I will give you an example. I did this video 3 months ago. On this video, we looked at KCB shares back then, and the price on that day that I was recording this video was 37 Kenya shillings, right? Now, let's see how high the price has gone ever since. And as you can see here, on January 2025, I recorded this video in December 2024. Yes, and in January 2025, you can see that we hit 45.8 Kenya shillings. So in a month, the market rose by 8.8 points. Let's do some calculations. If you invested, let's say 100,000 Kenya shillings in these shares that month, the day that maybe I spoke about these shares, it would mean you bought 2,702 shares or units of KCB shares, yes? If you multiply this with 45.8, it means that if you exited at the time, you would have made 23K in 1 month. That is, 23K is besides your capital. You would have made an interest, or you would have made a profit of 23,000 Kenya shillings in a month. This is the potential shares. But one thing with such an investment is we always tell ourselves it will go higher than it is. So we end up missing the 45.8 mark, and you end up seeing either your portfolio going back to where you started or even going lower. And my advice is take profits when the markets are going up, as we have talked about in cryptocurrency. Also in shares, usually you should be taking profit when the markets are going up. When the market, for example, if you buy at 37 Kenya shillings, when the market goes to 40, take some profit out of that market. Then when the market continue going higher, take profit. Keep taking profit as the markets are going up so that you avoid the risk of going back to where your portfolio was or even lower than that. And maybe I can introduce something that is very important that can help you, and it's called dollar cost averaging. And in simple terms, this is an investment strategy where you consistently invest a fixed amount of money in a particular asset, like maybe stock or REITs, at a regular intervals, say monthly or maybe quarterly, regardless of the asset prices. So what this does is it usually spreads out your purchases over time, which can help reduce the impacts of market volatility. And I know it is complex strategy, but we can learn something from it. I was once listening to a video by Good Joseph, and he was saying that he buys shares worth 2,000 Kenya shillings per month. And this is the same concept. What this does is you are able to buy the shares at different prices, and any movement to the upside, you are making profit or you are in profit. You can apply the same concept to selling the shares at, or maybe cryptocurrency, at different intervals. So when the market start going up, what you want to do is to sell at different intervals to make sure that you're making profit or you're taking profit from your investment. Okay, so make sure that you're using this strategy when investing in shares, when investing in cryptocurrency, to make sure that you're buying at a very favorable price and also selling at a very favorable price, and that way you're not going to be losing a lot in these investments. I know this video has been a long one, and also it has a lot, and I hope you have followed this video to this far. And if you missed something, let me know in the comment section. I'll be glad to clarify if you missed something or to go into details if you're interested in it. Okay, before we end the video, please just take a second to like this video so it will be pushed to more people who might need such a video or education or information about investment that they could invest in. Thank you so much for watching, and if you're interested in special funds, consider watching this video where I compared 4 different funds, and in this case now we know it's 2 special funds and 2 equity funds. So make sure that you watch them and let me know in the comment section what you think, or it's something that you're interested to invest in. Thank you so much and happy investing. Bye.